Welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Mysogland.
Welcome to another episode of Defenders of Business Value. I'm your host, Ed Mysogland, and today I want to talk about business value. And the thing that I want to focus on is different types of value. And a lot of the people that I'm working with or that have contacted me over certainly the last couple of years, there seems to be a disconnect over value, not necessarily disagreeing of the value of their company, but how there can be different values depending on who is valuing the company. And that is the topic today. I want to talk about value is in the eye of the beholder. And so I want to focus on that. Let's go ahead and begin with talking a little bit about, most businesses have a cost of equity capital. All right. A cost of equity capital of between 20 and 30%. All right. But the problem that we're bumping into is that most business owners don't generate those types of returns. And you will have heard me say over and over again that business value is about growth, expectations, and risk. And when we talk about earnings, we're talking about how much can I pay myself or someone to run my company? How much debt can I service? And how much of a return of and on my investment can I get? Those are the drivers of the value. And yet, business owners aren't able to generate those types of returns over the cost of capital. And what ends up happening is we get what's called a value gap. The value the value, the owner's perception of value versus the buyer's, you have this delta between the two of them, and where you find buyers that aren't, that recognize, and we talk here in a couple of weeks, we talk to John Murillo about drivers of value, and the buyers that I'm referring to are citing that the business owners just don't take those returns and reinvest in the company. And as a result, we don't have growth. All right. We don't have growth in a number of different ways, meaning that we're not reinvesting in equipment. We're not adding people. We're not entering new markets. We're not bringing out new products or services. Those are the kinds of things. Instead, what we're doing is we're just relying on a standard earnings stream, and that creates some challenges. All right. Next, I think I want to reinforce that a business has a ton of different values that are all right depending on who it is. And when we're talking about valuation in a sale environment, each respective buyer has their perception of risk, and that risk affects the value. So now, one of the things that, and it just happened this week, where I was reviewing a business valuation, and it was what's called a fair market valuation, and it was based on the principle of substitution, and the business owner, and the appraiser, and I mean, for the purpose that they were saying, it was right, but they took their fair market value appraisal and they were bringing it to me from a market standpoint, and we had differing opinions. And what I wanted to share was that there's a difference in how we approach that value, and because they're looking at public returns and applying it to private companies. So let's talk a little bit about the differences. So from a corporate structure, the public market is a C Corp. The private markets can be CS, sole proprietorship, LLC, LP. There is no difference. The public markets are the value is established by the market. And private markets, value is established at a point in time. So, for example, with the public markets, you're able to go, to any, you can go to Apple and pull up the stock, and you can see the value of that company right now. And with private companies, you have to have a buyer that's ready, willing, and able to buy for you to determine what that market value is. For private markets, they're able to have they have access to public capital, meaning they can raise debt just like that. But with private companies, they don't. They don't have access to that, and they have to get loans from various capital providers. So in public markets, the owners have very limited liabilities. The private companies, the owners have unlimited liability. In public companies, the owners are well diversified, meaning there's all kinds of shareholders. In private companies, owners tend to be, concentrated, meaning there's a few of them. So in public markets, there's professional management, and private companies, there's owner management. In public markets, we have an infinite life, that the company is built to have an infinite life. And then private companies, you tend to see businesses only lasting a generation. In public markets, we talk about liquidity. Liquidity is meaning I have the ability to convert my shares into cash within 3 to 5 days. In private markets, you have to actually sell the company, and that normally takes 6 to 12 months if it's going to sell at all. In the private or in the public markets, profit is the goal. Right? Not that every business profit is the goal, but theirs is profit maximization for the shareholders is. For private companies, it's personal wealth creation. That's how the differences between the two. So, and the biggest takeaways I want you to as you look at, or as you think about what I just said, it really comes down to liquidity and risk. All right. Both and access to capital. Those are the three drivers. So public markets have, they have, the risk is diversified. They have access to capital, and their intent is to grow the business and as well as the liquidity. They are able to take your whatever fractional interest you might own. You can create liquidity 3 to 5 days. In private companies, you cannot. So now, let's talk a little bit about the types of value. So value today, it's historic and forensic. And this is Rob Slee of Private Capital Markets. He really did a great job at identifying how this plays out as far as value is concerned. And we're going to talk about what he calls value worlds here in a second. But today we're looking at compliance oriented valuations, and some are measured with singular certainty. That's how value is defined today. Now, as I mentioned to you, he had a great way of looking at it, as far as he called them value worlds. And according to what he called the value world theory, the motive leads to the reason for the appraisal. The reason for the appraisal selects the value world, and the private business value is relative to the world in which it's viewed. And therefore, the private company has dozens of correct values at any point in time. So as we were talking about value worlds, the different types of value, and I don't know whether that's a value world is the appropriate term or not, but let's just say these are the different types of value. So you have market value. That's the world I live in. So that's what the open market says that the business is worth. And we use the asset approach, the assemblage of assets. We look at financial buyers, and then we look at synergy. And those are the values that could be under market value. So in other words, it's what we call strategic or synergistic value. We look at asset value, what is it for a financial buyer? And so that's what we use for market value. And that's probably if you're listening to this podcast, that's probably the valuation you want is what is your company worth on the open market? Then we move into fair market value, and that's what the IRS and courts say it's worth. You have the owner value, which is clearly what the owner thinks the business is worth. You have investor value. If you're raising money, what does the investor say it's worth? You have collateral value. What's the bank say it's worth? And then you have insurable value, startup value, public and fair value. Fair value meaning that there are no discounts. And so you can see that there are so many different types of value, and all of them can be right based on who is the author of the valuation and what its purpose is for. So keep in mind that that's what we're looking at. So the authority of the value. So in my case, the market value, I tend to be the authority because I'm in it. I'm the one seeing what businesses are selling for. And again, by virtue of taking a business through the process, we're able to determine what market value is, regardless of what we think, what we believe that the business is worth. And the process is the expert in our world. And so when they're in these different types of value, in the case of competing authorities, the one with the most compelling argument wins. In my case, and let me just give you an example, when rather than use what happened with me, I want to talk about another expert witness. And let's just say it was for equipment. I did an extensive analysis on a bunch of equipment, and the judge was really, impressed with all the work that I had done. And here's this guy that does not have the credentials I do. And he walks up and he takes the stand and he says, "Judge, I know that the work that this guy did is thorough, but I'm telling you, I was at an auction 2 days ago, and this is the value of this equipment." And he brought the evidence, and despite all the work that I had done, and for me, it was a compelling argument. His information was superior, even though my credentials were better than his. And so again, he had the compelling argument. And that's my point, is that depending on who is the authority or the arbitrator of that value, they're the ones that determine, who wins. So you need to also remember that with each of these types of value, the earning stream differs. All right. So an owner's value is when we're looking at just that, how much benefit to the owner. And then we use valuation from there. And then depending on who the buyer is, and we've talked about this a number of times with the guests that we've had on, is risk. Risk differs depending on who the person is and what this particular reason for value is. So a synergistic purchase, the earnings would be different because I may not need all of the back room because I'm going to merge it in. I may not need the facility because I have excess space. So for me, I'm picking up, these are the earning savings that I'm picking up. And since we're in the same business, we don't have the same risk that an individual buyer would have. So the the benefit stream or the earnings differs depending on who the buyer is. And then the return differs depending on the risk. And now we move into the highest price. In my world, the highest price is market value. Okay. For private companies. And it is for the assets or the stock of the company. And we look at the asset and the assemblage of assets, who's the buyer for those assets. We look at financial buyers and we look at synergistic buyers. Those are the three types. And who are those authorities? The authorities are M&A folks and business appraisers. And that's how we look at and why we're the authority, because we are the boots on the ground. And, let's just talk, we were just talking about the asset, the asset approach. Well, the asset, it's just it is an operating business without goodwill. And it is a challenge under the asset value because you're not getting credit for any kind of goodwill. And that creates problem because especially in service type businesses, that is the essence of the value of the company. So when we move into, the income stream, let's talk a little bit more about that. That when we talk about the income stream or the earnings versus the multiple. So financial and synergistic value, the earnings stream is the earnings stream times the multiple. And everybody uses EBITDA. So earnings before interest, taxes, depreciation, amortization times an acquisition multiple. All right. The earnings stream differs depending on who that buyer is. And then the buyer brings the multiple. And why does the buyer bring the multiple? Hopefully by now you've learned from me that the risk profile of each buyer differs. So regardless if it's a company or a person, that risk is their risk. We can't quantify it. And that's part of my problem with fair market value appraisals that show up at my doorstep is they're saying, well, given the alternative investments to where this, where a hypothetical buyer can invest their business, their earning or their return on investment needs to be 13.75%. Well, that's nice, but that's not real world. In our world, it's each buyer has their own risk profile. You can say it's a hypothetical buyer based on all kinds of other alternative investments. But in our case, it is not the case. In our case, we're like I said, the process is the expert in value. All right. So now I wanted, and let me continue on this little bit of a rant. So if you have EBITDA, all right, you have let's just take an example. You have a reported EBITDA of 1 million. We recast it and it's now 2 million, and a synergistic EBITDA is 3 million. All right. And now we use, let's just say a 5 multiple. So your value with reported EBITDA, so 1 times 5 is 5 million. Recasted 2 times 5 is 10 million. And synergistic recasted EBITDA is 15 million. So you can see, depending on whose earnings you use will differ depending on the earnings stream. All right. So we use market data to determine how a buyer typically behaves toward an investment. But when we move into synergistic values, it's a whole different ballgame because, as I said, unless you know who that synergistic buyer is and why they're doing it and what they're saving, you have no idea. So it changes and it will be difficult for us to to determine it without taking the business to market. Now, most private companies want to increase the value of their company in not only market value, but in strategic value. They fail at times. They fail to understand that the acquisition multiple is specific to that buyer. And again, I know I'm reinforcing that, but this is the big takeaway. And that risk affects their multiple because the multiple is risk. And then the return is, what is the EBITDA available post-acquisition? So again, I pay myself or someone to run it. I pay my debt and I get a return of and on my investment. So how, that drives my value. And how am I going to be able to grow the business? Or do I choose not to? But that's what the buyers are looking at. So now, let's look at fair market value. All right. As I said, I received an appraisal this week, and somebody was somewhat distraught over my opinion of their fair market value appraisal. And again, fair market value is perfect for IRS and courts, but it's not so much in my world. And so the question becomes, will fair market value mirror the reality of the marketplace? I don't know. I don't know if we're ever going to get to that place in valuation where we totally understand how I think we can get there with a range. I'm not certain we can get there as a specific number. Now I want to talk about transfer channels. Like, how do you transfer the business out of the, from your ownership to someone else? And again, a lot of this depends on size, but generally speaking, these are the ways you can transfer your ownership or divest yourself of ownership. One, you can go to the employees. You could go to charitable trusts. You can go to the family. You can go to other co-owners. You can go to outsiders. All right. And retire. You could go to outsiders and stay with the business, or you can go to, or take the company public. Chances are if you're listening to this podcast, you're probably not a public company. But when we go to employees, I mean, we're often talking about ESOPs and management buyouts. When we're talking about charitable trusts, we're talking about charitable remainder trusts, donor advised funds, things like that, where the business has been sold into a trust and either is being used for family purposes or for charitable purposes. If we go to the family, it could be gifts. If it goes to other owners, again, that's a buy-sell agreement. If it's to outsiders, that's my world, where we sell to independent third parties. If we are looking at outsiders and you continue to stay in the business, typically in private equity, those are roll-ups. And then public companies are, what a public company is. So the question is, and this is kind of tying this up, do most owners want to create value in their company? No, they don't. And this isn't a wrong answer. They just don't. They want to create a lifestyle. They want to create a lifestyle for themselves. But is there anything wrong with it? No, there is nothing wrong with it until, guess what? Until you go to sell. And then we have an issue, because now we are in a we are in a bit of a challenge on how to effectively transfer that company out. And so when we're, typically these things happen on a 10-year cycle. All right. So you, in our case, we're probably, from a timing standpoint, it's always good to sell a good business will sell in any environment. I think you're going to see for the next couple of years, it's going to be somewhat volatile, but then I think there's plenty of time to capture, great opportunity to sell. So, so at any rate, I do think that as we continue to, in election years, it's kind of hit or miss. Chances are our sales tend to increase, when there's a Republican president. Just is. I don't, I kind of have my opinions as to why, but nevertheless, there is, that's just often the way it is. So I would anticipate, 24 into 25, we start to pick up pace as far as, more people selling, and more people buying. I wanted the business owners that are listening to remember that they control the transfer value, right? They ultimately decide which of those transfer channels they want to pursue. Now, certainly I strongly suggest you talk to your accountant, you talk to an exit planner, you talk to, even your attorney about, if they're versed in M&A and transfer channels, what is ideal for you, because it may differ, because remember you have, and let's just revisit the values as they increase. So asset value is the lowest. Then we move into management buyouts, which are more investment value. You have ESOP. Again, remember what we were talking about. Those are the government fair market value determines what fair market value, that value world. Then you have, equity recaps. All right. So, when we have private equity groups that roll up companies and the business owner gets to keep a fractional interest of the company, that's a financial market value. Then we move into negotiated. All right. That's more, when we take it through our process, that's owner value. And then we have, through owner value, and then synergistic value. And then I told you in this case, and for my audience, chances are it's not public value. We don't have to address public value. So everybody needs to understand, that they need to create value in their company. And that's always been the challenge. And there's nothing wrong with it. But for those of you that aren't selling in the next, 2 to 4, even 5 years, there's excellent opportunities to begin the process of creating value. What can you do? You can stop being the person that drives all of the earnings. All right. If you go away for a month, what happens to the company? If you have customer concentration, how do you diversify that? If you have supplier concentration, how do you do that? Do you understand the cost of acquiring a customer? These are all, and this is just the very tip of the iceberg about the things that that you need to understand in order to create value. So to kind of conclude this, you need to understand for those of you that are moving into this, and I'm thinking about selling, the whole selling process is more sport than business. I mean, there's some bobbing and weaving, and those of us that know the game and how it's played are in a superior position to those that don't. The companies that need the most help, and this has been the case forever. Those that need the most help are the least willing to pay for it. Probably one of my partners, his name's Larry Metzing, and he has always said, in our world, the deal only starts once it has died. It's just it's when our fees are justified and when really the rubber meets the road. You need to understand that the more people that are involved in the M&A process, those that have experience in it, are ideal deal team members. Though you don't want to have to educate your attorney that did your cousin's divorce as your M&A attorney. It's going to end up badly for you. So the more you care about the deal, the less likely it's going to close. And I say that only from the standpoint of you need to be sale ready at all times. That's just good business, because as you know, and I guarantee that you receive letters regularly and calls about, hey, I want to buy your business. Well, if you're always in a position to sell, you can field one of those questions and determine whether or not that buyer is legitimate. And then I think the last thing is, there's no guarantees in M&A. Everybody may do everything right, and things still may go bad, and the deal may not get done. We had a deal where, there was some foreign capital that was going to fund a deal of ours for a family, and at any rate, the stock market of that country crashed, and everything was done. It was just waiting on funding, and it crashed and killed the deal. So it's never over until the checks get cashed. I think that as you think about valuation, I hope that the biggest thing you took from it is that there is a wide range of values depending on who that person is that's looking at your business. So don't be offended at it. It just depends who is doing the valuing. The other thing is that the process will determine the value. By confidentially exposing your business to the marketplace, you will ultimately figure out who the buyer is, what the risk is, and that determines your value. You don't have to accept it, but though you get 2, 3, 5 offers at generally the same price, you've determined market. So keep that in mind. And then lastly, we talk a lot about value and market data that we're seeing all the time. And if my door, we haven't been around for 40 years, not sharing information. And whether we do business or not, we are more than happy to share what we have to make sure that you make a great decision. So that's it for this week. I hope you enjoyed this rant about values and how value is viewed depending on who the buyer is. And then I'll see you next week. Thanks so much.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.